Good afternoon and welcome to today's exclusive webinar. My name is Luis Mendoza and I will be your moderator. Today we aim to provide you with insights on the current state of our economy and the financial markets, as well as give you practical and actionable advice in what we believe is the best way to maximize your earning potential amid uncertainties. Our speakers today are experts in their fields. They will be sharing with you their views and outlook on the economy and the financial markets. On top of that, there will also be a discussion on best practices and things you can use to improve the earning potential of your investments. But before we begin, may I remind everyone that you may type in your questions in the chat box to your right, even while the presentation is ongoing. Now, to formally welcome everyone and start off this presentation, let me call on the head of Metrobank's Trust Banking Group, Dondi Santillan.
Good afternoon, everyone. Thank you for joining us today on behalf of Metrobank Chairman Arthur T., President Fabian D., and Financial Market Sector Head Toto Tancinco. I'm pleased to welcome you all to this exclusive markets briefing webinar by Metrobank's Trust Banking Group. 2020 has been a challenging year. January started with the Taal eruption, which resulted in a negative GDP print in the first quarter. This was followed by the pandemic, which effectively shut down the economy in the second quarter, resulting in an even worse GDP print at negative 16.5%. In my 30 years of working in investments, this crisis is unparalleled. The 1997 Asian financial crisis and the 2008 global financial crisis pale in comparison. For the first time, this not only affect the financial status of consumers, but it also took its toll on individuals' emotional and psychological well-being. This is why today's talk on economic outlook and effective investment strategies are topics relevant to gear you up as you navigate through these challenges. Since the onset of the pandemic, it has always been our goal in Metrobank to ensure that you, our clients, are continuously able to do meaningful banking and have uninterrupted access to sound financial advice from our pool of financial experts and investment specialists. Significantly, this webinar series allows us to further the bank's advocacy of championing financial education and gives us the opportunity to intimately converse with you and offer you tailor-fit solutions for your every financial need. As always, you can count on Metrobank to guide you as you move forward in your financial journey. I will not take any more of your time. Once again, thank you for honoring us with your virtual presence. I hope you will find this webinar insightful and meaningful. Thank you.
Thank you, Dondi. To begin our program, of Metrobank's Trust Banking Group. His team specializes in covering macroeconomic fundamentals of various markets and comes up with actionable insights for the investments team. He has 11 years experience in the financial sector, 9 of which are in investments and asset management. Please welcome Jon Munsayac.
Good afternoon, everyone. Once again, I am Jon Munsayac from the Markets Research and Strategy Department of Metrobank Trust, and I welcome you to today's webinar entitled Maximizing Your Earning Potential Amid Uncertainty Through Asset Allocation. Now, that might seem to be a mouthful for a lot of people, but hopefully as we go along this webinar, and we'll be able to present a clear path towards you and your financial goals. So we'll start off the market outlook with a quick discussion of what's happening in the markets in a quick brushstroke kind of way. We're going to start with the main catalyst that has been hounding Philippine markets so far, which is COVID-19, and we'll end the market outlook portion with what we believe would happen in a few months from now. So right now, COVID-19 has been the main catalyst of a lot of market movement for the year. So far, the Philippines has already endured around 7 months of quarantine measures. And as of the latest numbers, last October 12, we already have around 350,000 cases, as well as almost a little over 6,000 deaths. Now, the main trick of COVID-19 is really the fear of contracting the virus, and thus it has made people to start staying at home and trying to avoid doing their everyday routines. So for us, this means less coffee breaks, less Starbucks. This would mean less movie nights as well as dinner out with friends, as well as less vacationing and less classes like basketball and guitar lessons for the kids. Ultimately, COVID-19 has mostly kept people in their houses and not spending. It's not spending less and even saving more in anticipation for things to come. Now, with that particular new behavior in mind, we're seeing that demand for goods and services has slowed down for the short term. And as a result, we saw in the latest growth numbers in the Philippines a negative 16.5% GDP print. Now, the overall slowdown is really something new for the Philippines. In the last 10 years, to give you a background, overall GDP has been playing at around an average of 6 to 6.5%, with 2019 GDP coming at 6.3. Now, GDP is an overall measure of consumption and spending inside the country. Now, this is not just the big ticket infrastructure projects of the government, as well as the spending that they're doing in order to battle COVID-19. We as citizens also contribute to spending and GDP from our everyday usage of our salaries and revenues. Every time we fill up our gasoline, we contribute to GDP. Every time we buy groceries for our houses, we contribute to GDP. And every time we go on vacation or every time we go to work, every time we spend, we are contributing to GDP as citizens. In fact, if you break down the main contributors of GDP, it's really not government spending, it's not imports or exports, but rather it's consumer spending. We as citizens, we as consumers are the ones that are contributing the most to GDP. And on average, given that COVID-19 has lessened our capability to spend, this has brought about that negative 16.5% GDP print. Now, in terms of the most affected sectors, definitely tourism, airlines, hospitality are the most hit. Although with no customers, a lot of these companies are really forced to slow down. Now, it's not the big ticket ones or the big companies that are taking a hit. Most of the ones that took a hit are medium, small, and micro enterprises, which contribute around 95% of the business landscape. These small businesses without any customers are forced to temporarily close their shop or close it entirely. Businesses are forced to close, causing unemployment to really rise. Now, the peak of unemployment came about during the start of the lockdown procedures sometime in April 2020. The good thing about it is that towards as the months go by, people are starting to learn and trying to adapt and live with the virus. The latest unemployment numbers that came in July came in at 10%, which is which is a very good improvement compared to the 17.7% print that came about. Now, forgive me for being a little bit too technical in the next few slides, but I'd like to share that given the resiliency of the Filipinos, people have really started to go back and look for work amid the virus. With more transportation coming in due to the government's intervention, more and more people have started to look for jobs. Now, the participation rate is basically the amount or the percentage of Filipinos with working age from 15 to 65 that either have jobs or are searching for jobs. As you can see, there was a dip in April coming in at 55.6%. However, given the latest quarantining procedures in NCR as well as the rest of the country, more and more people are really venturing out to the point wherein number of people searching for jobs and the number of people who have jobs have gone back to pre-COVID levels. Now, in order to support this particular venture and in order to make sure that the most affected regions are still supported, the government has been helping out in the tune of around one or around 2.7, 2.6 trillion in terms of funds. That's a combination of government spending and as well as support from the Central Bank of the Philippines. Now, what we need to do moving forward is to really continue to learn to adapt to the situation. The vaccine, given the latest news headlines, might not arrive in the country in this year or even early next year. However, given the resiliency of the Filipino and the help of the government, a lot of consumers believe that a year from now things will get better. A survey from the BSP on consumer and business confidence from reflect that 1 year from now, it seems that consumers are a little bit more optimistic compared to their business counterparts. As you can see on the chart to your right, consumer sentiment has started to pick up from 19.9 to 25.5, signaling that the consumers, which is the heart and the blood of the economy, is really starting to perk up. Apart from the fact that people are beginning to learn to live with the virus, um, consumer sentiment has been going up due to the fact that the government is also trying to help. Moving forward, given the trying times that we experienced in the last few months, we believe that the next few months will be a bit more lighter compared to what we've experienced. As the government opens the economy more and more of our fellow citizens will start venturing out and looking for jobs and spending. And with the return of this spending, we believe that this is what we will be needing in order to kickstart a faster change. Now, the faster we try to live with the virus and the faster we adapt the new normal, the faster the recovery will come. And I believe that moving forward, that would be the case, despite all that we're seeing and despite all the headlines that we're seeing right now. So that's it basically for the market outlook. I'm hoping that it was helpful to everyone. And now I will turn you over back to the rest of the team. Thank you and good afternoon.
Thank you, John, for your insights. I think it's important that you mentioned that the outlook for the next 12 months is more positive. And as part of the consumer base myself, I'm certainly more optimistic and hopeful that the worst is behind us. If anything, I think a good takeaway from your discussion is that amidst the pandemic, there is still opportunity for investors to earn money and build their wealth. Just a quick reminder to our audience. Again, you may key in your questions in the chat box to your right. In that way, we can answer them later in the Q&A session. You may do this anytime during the presentation. Our next speaker heads the Portfolio Strategy and Advisory Division of the Trust Banking Group. His team specializes in strategy formulation, asset allocation, and portfolio construction necessary in managing the various portfolios handled by the team. He is a CFA charter holder with 10 years experience in banking, investments, and asset management. Please welcome Don Hernandez.
Hi, good afternoon. Thank you, Luis, for that kind introduction. Now, ladies and gentlemen, I hope you enjoyed what John presented a while ago. It's clearly a bright future that we're going into in the next 12 months, right? Now, the topic of this webinar is maximizing your earning potential amid uncertainty through asset allocation, right? But before I go into details and teach you the technique that that I would advise to you, let me ask you first one simple question to introduce and get the ball rolling. Okay. So first off, why do you invest? Okay. If you were asked this question, usually the automatic response is, I want to earn. I want my money to earn. But here are four people that we've interviewed, and basically the response to that question, why do you invest, is they're pretty much different. The retired marketing executive says that he invests his money to beat inflation. Now, a retail shop owner said she's really exposed to her business anyway. She'd like to expose her money more to other instruments that might earn. The doctor, on the other hand, is 32 years old. This is the dream. Investing is a way for my savings to grow while I work full time. Make my money work for me. And last but not the least, management trainee who's basically 25 years old. She says it's never too early to save up for retirement. And guys, she's not wrong. Okay? So the point of this slide is that why do you invest? It's really not just to earn. In this webinar, I'll quickly introduce you to the concepts of portfolio management and asset allocation. And of course, later I will be teaching you a technique I would like to call sticking to your investment path. So let's begin. Portfolio management and asset allocation. First, defining a portfolio is simply a mix of investment assets. But is it really as simple as that? Portfolio management is basically matching investment decisions with investment objectives. That makes the definition of a portfolio not a simple mix. How can we make this a little bit easier to understand? Imagine yourself in a buffet table with your friends. You get your food on your plate, and if you look into your friend's plate, it's actually quite different, right? If I go to the buffet table, I would be taking in a different set of food compared to the plate of what John has or what Luis has. Okay? And that's because we have different needs. I probably ate 2 hours ago. Well, Luis and John might have skipped breakfast and lunch. And basically, I'd probably take on salad and soup. But John and Luis would probably take in more meat, more carbs, more pasta, more rice. And it's different because they do have different needs compared to my own needs. When I'm just really there to, fill in something that's a little less appetite compared to what they have. So a portfolio is the byproduct of matching objectives, decisions to your objectives. Okay. Now let me give you an example. This is a sample portfolio. Now, visually, this is actually a balanced portfolio. You have 15% in bank deposits. You have 40% in bonds, 30% in Philippine stocks, and 15% in U.S. stocks. But I guess the big question here is that, does this portfolio satisfy your objectives? Does it satisfy mine or Luis or John's or your friends? Now, before we answer that, let's introduce you to 3 more people. A retired pensioner who's living on interest, short-term capital needs, and cannot afford to lose capital. Reason being is because he's already retired. An entrepreneur who's basically a businessman really in nature. He has excess funds which he will use 5 years from now so that he can expand his current business. And the last one is a young professional who has a 25-year investment horizon. Because she's basically saving or investing so that upon retirement she has enough funds to supply her own. Now, if we all put them side by side, the question is whether or not the portfolio to your left will satisfy the objective of each of these 3 people. If you see that the portfolio, the performance in the bottom left corner of the screen, the portfolio earned 5.1% on the first year, and on the second year it lost 1.5%, then 2.8, 14.5, and 9.5% in years 3, 4, and 5 respectively. So given that year 2 lost 1.5%, it might not be the best portfolio for the retired pensioner. The reason being because he cannot afford to lose his capital. He can't lose his principal. For the young professional, he has 25 years of investment horizon. This will give you a decent 5.9% in return. However, this might not be the most efficient portfolio for the young professional. Given that she has a long-term investment horizon, she can probably take in more risk. And for those who are familiar, stocks have more risk compared to bonds, and bonds still dominate this portfolio. Nevertheless, I will discuss that later in detail. Okay. Now, the entrepreneur, on the other hand, will use this portfolio, I think, well enough. He has a 5-year investment horizon. And if we're going to have an assumption that history will repeat itself, this might be a good fit for our entrepreneur. Now, what my point being is that please remember that each person has a different objective. Each person has a different pie. Each person has a different plate in the buffet table. That includes you. You have a different objective compared to your peers or even your brother. Okay? Now, how do we do the matching of decisions to objectives? Now, let me introduce you to the concept of asset allocation. Now, defining asset allocation, it's basically investment strategy that balances risk and reward by considering individual goals, risk tolerance, and investment horizon. Now, this definition has actually put a big emphasis on risk and reward. Now, why is this so? Imagine three types of assets: time deposits, bonds, and stocks. Okay? Let's start with time deposits. Assume you have a hypothetical 100 pesos that you invested. It starts off at 100 in the year one, and basically your bank deposit probably gives you 1% per annum over the next 5 years. So your 100 pesos at the end of 5 years would give you 5 pesos, give or take. Okay? It's a straight line, meaning you won't really lose money assuming the bank is safe and sound, but you won't have too much of a spectacular return, 5%, right? A second line I'll introduce you is the line for bonds. Bonds will actually have a superior return over deposits. But if you're looking at the midway through the investment period, there's a little bit of stagnation there. The returns were actually even almost the same as a deposit. But nevertheless, on the longer period, it actually outperformed your deposit. And last one will be the Philippine stocks. Okay? Now, Philippine stocks at the end of the period actually gave a very high or superior returns over bonds and time deposit. But midway through your investment horizon, you'll actually see that it actually lost money probably between the second and the fourth year, right? And this is something that's inherent in stocks. It's riskier compared to bonds and deposits. Now, what we're going to see here is that creating a portfolio through asset allocation allows you to balance your return needs and risk needs. And let me introduce you to a fourth line through this graph. This green line is actually a balance of 10% time deposits, 60% bonds, and 30% Philippine stocks. Now, if you're going to look at it and observe it, the portfolio actually outperformed your bonds and your time deposit. But in the middle of it, when the stock market actually lost some money, your portfolio actually balanced it out with the returns of your bonds and your time deposit. So having a portfolio basically saves you from that intense price swing, but it gives you that benefit of superior return that comes from these risky assets at the end of the entire period. Okay. Now, what you have to remember is that each asset has its own characteristic with regard to risk and return. That's why it's important for you to understand your ultimate objective before making an investment decision. Now, let me introduce you to these assets further by looking at the investment spectrum. You have to understand risk and return relationships here. So you see here cash accounts. Here are your deposit accounts, your CASA, your time deposits, your money market funds, and for those who are familiar, treasury bills. Bonds are actually government bonds. If you've seen the news recently, it's about retail treasury bonds, fixed rate notes, things like that, and corporate bonds, which are debt that was publicly issued by private corporations. And the last part in the investment spectrum is actually the stocks or equities. And the instruments are actually evidenced by the shares of stocks, which are ultimately evidences of ownership of that company. Now, if you're looking at the investment spectrum on the top portion of this slide, you'll see that as you go through the investment spectrum, you adjust your possible long-term returns, your risks involved, and your required investment horizon. Okay, so if you're invested in cash accounts, you'll have less risks involved, and you can do 1 month in terms of investment horizon. But you have to bid farewell to your possible long-term return since it's pretty much smaller compared to bonds and stocks. Which is, on the other hand, stocks will be the complete opposite of cash accounts. You will have a tremendous amount of superior possible long-term returns. However, you have to take in more risks and more time or required investment horizon to invest and be committed to. Okay, so you can just not look at these three assets. Remember, you also have other asset classes that you can look at. You have real estate, commodities, cryptocurrency, or for those who probably know Bitcoin better, art and collectibles and jewelry are all part of your wealth, and you have to manage it in your portfolio all at the same time. Now, remember, setting your objective is the foundation of portfolio management and asset allocation. Given that, I devised a technique that may be easily remembered. I call it sticking to your investment path. So we're moving into the technique in terms of asset allocation and making sure that your foundation is clear enough so that you can set your own objectives. And when we do about investment path, I devise it this way. When making investment decisions, always remember to stick to your investment path. PATH. The P stands for the purpose of the fund. A is for the appetite for risk. T is for your time horizon, and H are for your hurdles. Now we'll go through each of the letters moving forward, and I will present you guide questions that may be of use for you to efficiently look for your investment objective. So let's start off with the first letter P. Purpose of the fund. Now, the purpose of the fund, I keep on telling you, you have different objectives. It's really not just to earn. Now, you have to ask yourself, what is your hurdle rate as an investor? What are your financial goals? But I think one of the most important things that you have to ask yourself and you have to be clear about yourself is, what is your purpose for that specific portion of your wealth? Right? You have to be specific. Is it for retirement? Is it to maximize your inheritance for your heirs? Is it for future obligations like tuition, college education, can be for medical, for donation purposes, things like that, living expenses, okay? Now you have to be specific with that portion. Now I have a tip here at the bottom. Age is considered in suitability assessment, but should be analyzed together with your actual purpose, okay? So what do I mean by this? Assuming an investor is already 70 years old, if that investor approaches me and asks, can I still invest in stocks? Now, if probably 20 years ago, he asks me that 20 years ago, the traditional way of doing finance or investment management is that you're already 70 years old, you might not be able to take risks. So my answer would be a straight no. But actually now, what I'm going to ask that person is, what is your purpose for your fund, for your money, for your wealth, for that portion of your wealth? And if he says, it's actually for the college education of my grandchild, which will take probably 10 years from now. Now, I see that this person still has about 10 years in terms of investment horizon. Now, being that so, why will I deprive this person or that portion of his wealth to experience the benefits of long-term possible returns that would be brought about by stocks? So again, age can be considered, but you have to tie it together with your actual purpose. So it's not enough that you state your age. You have to be clear about the purpose of your fund. Now I'm setting here 3 examples of clear return objectives. Okay, these are sample return objectives that are simple and I'll start off with 2 simple examples and a more complicated one, but nevertheless they are clear. Okay, so the first example is this person who has 1 million pesos now. And it's clear that he will pay off his child's tuition 10 years from now. And he needs about an additional 500,000 from his current 1 million. So it's clear he needs 500,000 pesos 10 years from now to pay off his child's tuition. It's clear. The second one is, I have excess funds of 1 million pesos now, but I need to withdraw 50,000 per year. Now, it's different from the first person, but it's pretty clear that he requires to spend 50,000 pesos every year, and the funding will come from the income earned from this 1 million pesos. Okay? And now the third one is a little bit more complicated, but again, still clear. This person has 10 million pesos in his account. He needs to pay annual expenses of about 300,000 pesos while maintaining his purchasing power over the years. Now, it's clear that he'll be using the 300,000 pesos withdrawal for living expenses, but he also said that he wants to maintain his purchasing power, or probably a more common term is he wants to protect himself from inflation. So over and above his 300,000 pesos expenses goal or objective, he wants to basically adjust his wealth based on inflation. It's clear as day. Okay? Now, again, this is your letter P. Sticking to your investment path starts with your purpose. You have to identify what is your purpose for your fund. If your answer is simply to earn, you have to ask yourself again, what is your purpose of the fund? And then we move to the second letter A, appetite for risk. Now, when people ask you what's your risk appetite, it's quite difficult to, answer it. Am I risk averse? Am I a risk taker? Usually, you will probably look at how your friends did it and probably copy his risk appetite. But for you, my tip here, when you're sticking to investment path, when you're looking at your appetite for risk, you have to check two things in terms of your risk. Your first is, what is my risk capacity? Can I afford to lose the portion of this portion of my wealth? And the second question is, what is my risk tolerance? What is that risk level that I can confidently take? Okay. Now, I guess I can explain this more in Filipino a better way, right? Your risk capacity is kakayanan mo to take in the risk. Kakayanan. And your risk tolerance is that risk level na kaya mong dibdibin. So risk capacity is yung kakayanan mo. Your risk tolerance is yung kaya mong dibdibin. So those are two different types of appetite. But if you're clear with what they are, you'll be able to answer your appetite for risk. Now, if you're faced with a situation that one is lower than the other, or one is more conservative than the other, then you have to use the more conservative of the two. Okay? Now, again, if you're looking at the tip at the bottom, do not be blinded by the performance of other portfolios. Your portfolio is tailor-fit for your own objectives. Okay? Let me clear that out again. So it doesn't matter whether your friend is earning 12% and you're only earning 5%. Probably he has about 90% in stock market investments. You only have 20%. But that's because when you made your objective and you considered all your purpose, your appetite, your time horizon, and other hurdles, your optimal asset allocation is really a more conservative type compared to your friends. So do not blindly follow the portfolio of your friends or others just because they are earning more. Remember, when they're earning more and they basically have more potential for returns, they're also taking a higher risk. So if you cannot take that much higher risk, then you have to stick with your own objectives, which you should start with at the beginning of your investment journey. Okay? Now, like the purpose, it has to be clear. So I have 3 examples here of statements that basically highlights their risk profile. First, I only have my life savings to invest, but I can weather the swings of stocks. Now, he can weather the swings of stocks. Tolerance-wise, it's pretty high. He can weather and kaya niyang dibdibin the price swings of stocks. However, if you're looking at this person's capacity, he only has his life savings to invest. If mawala yung life savings, then you have to start over. So your capacity has a lower risk profile compared to your tolerance. If this is the case, you have to have a less risky portfolio because your capacity is lower. And basically, you have to be more conservative. The second person is, I have excess funds to invest for 10 years, but I can't sleep when I see losses. Now, this is the inverse of the first person. This guy has more capacity because he has excess funds, and he can invest 10 years. So he can forget about the money and just come back for it. However, he made the statement, I can't sleep when I see losses. I mean, it's impossible for you to check on your investment after 10 years. You have to check it once in a while. So when he sees losses in his portfolio, he won't be able to sleep anymore. So that example shows that his tolerance for risk is actually lower compared to his capacity. So then again, you have to choose the more conservative of the two. This person should have a less risky portfolio. Now, the third person here is clearly different compared to the first two. Clearly, his capacity is 25 years. He's saving for retirement in 25 years. And he is experienced in stock trading, and he understands that stocks are long-term investment vehicles. So capacity is very much high, and his understanding and his tolerance is also high. So compared to the first two, this guy's portfolio will be more aggressive compared to the first two. Again, you have to be clear not just with your return objective, but also your risk objective. The third letter in the investment path is your time horizon. You have to define your time frame. But I have to start with the tip at the bottom of the slide. Remember that investing is a commitment. Okay, I'll repeat that. Investing is a commitment. When you start with your investment and you define your time frame, you have to finish your time frame. Okay? You cannot pre-terminate your investments just because you need it to buy a car or do something leisurely. Remember, you have a purpose for the fund and you've defined your time frame at the start of your investment journey. So you have to ask yourself, how long am I willing to hold on to my portfolio? Will my purpose for the fund be fulfilled within my stated time horizon? Am I amenable to extend? Things like that. But the bottom line is you have to be clear with the time horizon or the time frame that you've defined for yourself. So again, like the first two letters, I'll give you three examples here. The first one is, again, clear enough in his purpose that he's a bachelor student or graduating bachelor student that will pursue law, a law degree afterwards, but he'll take it 5 years from now, and his investment is being saved specifically for that purpose, that in 5 years' time he will enroll in law school. Second person is an example is the one I mentioned in my age example. 70-year-old millionaire, grandkids will have fine upscale college education. His grandson is actually just 10 years old. So if you follow the current norm that college is on average is around 18, 19 years old, he probably has about 8 to 9 years at the least for his investment. So that's still a longer period of time. And the last one, clear as day, 30 years old, 60 years old in retirement. So 30 years in terms of time horizon. Again, I'll finish this letter with a reminder that investing is a commitment. You have to commit yourself to the defined time frame that you've written at the start of your investment journey. Now, in this investment path, we go to the last letter, hurdles. You have to scheme other considerations. You have to look at your tax concerns. You have to look at your legal challenges. You have to check whether or not you have set aside enough liquid funds to cover your current expenses. Do you have enough emergency funding? What if there are unexpected requirements? Will you be able to fund it? Things like that. But I think the one thing that I will always tell my clients is that when you are doing your investments, you should always check whether or not your investment portfolio will be in line with your personal values and principles. Okay? Again, personal values and principles. If you're that type of person who doesn't want to fund the operations of a gaming entity or let's say a tobacco entity, then you shouldn't put those names in your portfolios. Okay? Never put yourself in that situation where your investment portfolio contradicts your very own personal values and principles. Okay? Now, I'm actually done with investment path. I've shown you the 4 letters of investment path. Now, what do I do from here? It's actually time to build your portfolio. And what are my options? Okay. You can either invest directly if you have enough capital and time to understand the dynamics of the markets. You can directly invest in stocks and bonds. There you'll have control of which assets you will be exposed to. On the other hand, you can invest through collective investment schemes like Metrobank's UITFs, which can satisfy your investment objectives just as well. Okay. Now, one of the misconceptions in investing is that investing is for the rich, and it is really expensive. Now, to clear that up, no, it is not just for the rich, and it is not actually expensive. You can actually afford investing in, let's say, a UITF for as low as 10,000 pesos for peso UITFs, and for as low as $500 for US dollar denominated UITFs. Now, when you invest directly, you'll have to consider fees, minimum investing amount, and of course, the time and knowledge. You have to, watch over your portfolio day in and day out, and you have the time and knowledge and sophistication to look at it. But if you invest in a fund, it's affordable. You have better earnings potential. The reason being is that these are managed by practitioners who have great experience in managing financial markets or managing portfolios for that matter. And the other one is for diversification. Okay? Now, these are your options. So it's time to look at your key takeaways and tips for this webinar. So 1, I have to remind you that you have to stick to your investment path. PATH, purpose of the fund, appetite for risk, time horizon, and investment hurdles. Now, number 2 is you have to keep learning. Investing is an evolving art and science, but I have to remind you that whatever you've learned, before you implement it or before you execute it, you have to make sure it matches your objectives. It doesn't mean pag nakita mo yung friends mo or you see your friends investing in a new type of investment, you have to follow that all at the same time. No, no, no. Don't do that pitfall. You have to first look whether or not that investment matches the objectives that you have stated for that specific portion of your wealth. Okay? And the last is basically speak to experts. Okay? Speak with experts. You see, at the end of the day, you'd want what is best for you. Once you have answered the investment path, let the experts guide you in creating the right portfolio for you. That being said, you may approach the nearest Metrobank branch near you or visit our UITF webpage at metrobank.com.ph/invest/UITF for more information. Now, that actually ends my portion for investing, for my investment path. Thank you for listening in and tuning in our first ever webinar in the Trust Banking Group. And I bid you to keep safe and good day to you. Now, I'll turn this over back to Luis. Thank you.
Okay, thank you, John and Don, for your presentations. I'm sure that our listeners have drawn very practical tips and actionable insights from it. I guess for me, what really stands out from your presentation is that we have to stick to our own investment path, and regardless of our purpose or risk appetite, we have to understand that wealth building really is a long-term commitment. Before we read some of the questions, we'd also like to request everyone to provide your feedback on this exclusive event. You have the option to either use your smartphone and scan the QR code flashed on your screens, or click on the link on the right-hand side. You may do that now. So while our viewers are providing us with their valued feedback, let's now proceed to the question and answer portion. So we have our first question here addressed to Don. How
Okay.
long of an investment horizon do I need if I prefer to invest majority of my funds in stocks?
It's a very good question. Remember, if you remember the investment spectrum that I presented a while ago, stocks are on the right side of the spectrum, meaning you would have to dedicate a longer time horizon, horizon compared to cash and bonds. Now, what time frame maybe? Now, you see that the reason why it has to be long is that you're basically investing in the business. If you buy shares of stocks, you're basically buying ownership to that business. And for business owners, you'll understand that you won't be able to basically recognize the fruits of your labor after a few years. Okay, so in our portfolios, whenever we see equities, probably up to 50 to 60% of your portfolio, you can probably have at least 5 years. But there's a study actually that's about within the past 10 years, or this study says that over the past 50 years, there is no 10-year period that equity indices have not returned the money. So in short, if you hold into stock market investments for at least 10 years, I can't say the word guarantee, but basically, historically speaking, you'll probably return with a positive return. Okay, you'll probably have a positive income after 10 years of holding equities. So if you have majority of your funds in the stock market, you'll probably have to hold it at least 8 to 10 years so that you can see the fruits that the businesses have put their efforts into.
All right, thank you, Don. We have another question here. As the government opens up the country, the number of COVID-19 cases are not flattening or dipping. Should I maintain an optimistic outlook for the next 12 months, or should I remain cautious with my approach with managing my portfolio?
Okay, that's a good question. Again, let me restate that. As the government opens up the country, the number of COVID-19 cases are not flattening or dipping. Should I maintain, should I maintain an optimistic outlook for the next 12 months, or should I remain cautious with my approach and with managing my portfolio? Now, first things first, we can split the question in a few parts now. If you've seen the presentation of John a while ago, the 12-month forward expectations are actually it's actually very positive. No, the return of consumer confidence is something that people are waiting for. If you've listened through John's presentation, consumer consumption, or the consumer spending, the spending of you and me actually takes about 67% of the country's GDP. Now, as consumer confidence comes back, the outlook was a lot more positive compared to for the past 6 months. Now, should you remain cautious with my approach with managing your portfolio? The answer is until the vaccine is there, you can't probably say that you're going to be 100% bullish and put yourself 100% in stocks. However, again, if you've go back to my to my investment path, I would have to ask you, what is your objective for the fund, and how long are you going to hold on to it? If you have about 1 year or 2 years left in your investment horizon, then I suggest you remain cautious. Okay. However, you still have a longer time period, 3 or 5 years, 6 years. One of the insights that our stock market of managers are actually saying is that these are very cheap times, and basically after 5 years, 3 to 5 years, you'll probably have a good set of returns. So if I will go back to this question based on your investment horizon. If you have a shorter time horizon, you have to be a lot more cautious. But if you're going longer term, you still have a lot more leeway to go. Then go ahead. You can take in some risks with the assumption that the COVID-19 will be gone by then.
All right, thank you. We have our next question here. Given the current pandemic, what sectors are we bullish in? Also, follow up to that is, once we have beaten the pandemic, which sectors are we bullish in?
Okay, so for now that the pandemic is still in the country, definitely we like defensive sectors. Particularly, these are the sectors that would continue to operate given that the public really needs them. For example, would be consumer staples. As well as for this particular case, we also like telcos, given the rise of the new work from home arrangements and the need really to connect with people without really being in front of them. Now, it's a different story if we're talking about when the pandemic is over. Definitely, with the pandemic over, you could expect the consumer sector as a whole to start gaining momentum, given that people will continue or will start to go out already, given the long months that they've been sort of restricted, given the quarantine measures.
All right, thank you, John. Next question is, how will the big ticket infrastructure projects of the government affect the economy?
Okay, so again, that's for me. Basically, right now, the government is banking on these infrastructure projects to kickstart the economy. They're hoping that the actual economic activity of building and spending for these large projects would give a kick to GDP. Now, a long-term effect of these infra projects will be that it would remove bottlenecks in the economic activity as a whole, which means less traffic, which would mean faster delivery of goods from one place to another and faster delivery of people from one place to another. So there's really two particular effects on that. Number one right now would be the additional spending, and number two would be its long-term effect that we believe would have a great benefit for the economy in the future.
All right, so we have time for one last question here. I think this is for you, John. What is
Okay.
your forecast on the dollar peso exchange rate for the short term?
Okay, right now the peso has been strengthening against the US dollar for the most part of the year. Now, we believe that for the year 2020, it would end somewhere close to where it is now at 48.20. Now, as for 21, it's a little bit tricky. We feel that there might be some downward momentum. We might see some 47 level there somewhere, but ultimately the trend would be more depreciation rather than appreciation for the peso next year.
All right, thank you, John. I hope we were able to cover most of your questions, everyone. Thank you again, John and Don, for being with us today and for what you have shared with us. We hope everyone gained insights from your presentations this afternoon. We also want to thank everyone for tuning in our very first webinar. Your presence and attention truly means a lot to us. Before we end this session, we would appreciate if you can spend a minute of your time and answer our short survey. You have the option to either use your smartphones to scan the QR code that's flashed on your screen, or you may also click on the link on the right-hand side. So that concludes our program. On behalf of the Trust Banking Group, I would like to thank everyone for participating in this exclusive webinar. Again, I am Luis Mendoza, your host, signing off. Thank you, everyone, and stay safe.